You've got $20,000 sitting in your bank account. Now what? Most people either leave it collecting dust in a savings account or worse, spend it on something they'll forget about in a year. But what if that same $20,000 could eventually replace your full-time job? Sounds too good to be true? Stick with me, because today I'm going to show you exactly how investing in SCHD can do just that. We're talking a one-time investment that, with the right strategy, could grow into a portfolio worth close to $1 million and pay you over $70,000 every single year in dividend income. Let's break it all down.
What is SCHD? First things first, what even is SCHD? SCHD stands for the Schwab U.S. Dividend Equity ETF. Think of it as a carefully curated basket of some of America's most reliable dividend-paying companies. When these companies make money, you make money through regular dividend payments deposited right into your account. But SCHD doesn't just pick companies randomly, it follows a strict selection process. To even be considered, a company must have paid consistent dividends for at least 10 years and hold a market cap of at least $500 million. Liquidity matters too. These stocks need to be easy to trade. From there, SCHD narrows things down by looking at dividend yield, dividend growth, and overall financial health. It selects the top 100 stocks, making sure no single stock exceeds 4 to 5% of the portfolio and no single sector goes above 25%. And every quarter, the fund rebalances to keep everything dialed in. The result, a rock-solid collection of financially healthy companies with a proven track record of rewarding their investors. What's inside SCHD? So who are these companies? Some of SCHD's biggest holdings include names you almost certainly recognize: AbbVie at 4.71%, Coca-Cola at 4.66%, Amgen at 4.5%, and Cisco Systems at 4.4%, just to name a few. These aren't flashy startups. These are battle-tested giants across technology, healthcare, consumer goods, and more. Companies that have survived recessions, market crashes, and everything in between, and still kept paying their shareholders. In total, SCHD tracks the Dow Jones U.S. Dividend 100 Index, companies that have proven they can weather any storm and keep delivering. The stock split you need to know about. Now, if you've been following SCHD, you may have heard about something big that happened in October 2024, a 3-for-1 stock split. That's actually pretty rare for an ETF, so let's quickly break down what it means. In short, if you owned 1 share before the split, you now own 3. But here's the key thing: your total investment value didn't change. The price per share is now 1/3 of what it was, but the overall value of your holdings stays exactly the same. So why do it? Simple: accessibility. A lower share price makes it easier for everyday investors to buy in. It also opens the door for more options trading activity, which increases liquidity and market participation. Bottom line, it's a good thing for investors at every level.
Why SCHD stands out? Let's talk numbers for a second, because a few metrics really make SCHD shine. The expense ratio is just 0.06%. That's almost nothing. Most of your money stays invested and working for you, not being eaten up by fees. SCHD also manages over $70 billion in assets, which tells you one thing clearly: investors trust it. That kind of capital base means massive diversification and much lower risk from any single company taking a hit. And with 12 to 14 million shares traded daily on average, liquidity is never an issue. You can get in or out whenever you need to without moving the market. The goal: replacing your full-time job. Here's where it gets really interesting. According to the U.S. Social Security Administration, the average American earns about $66,000 a year, roughly $5,500 a month. That's our benchmark. Can a $20,000 investment in SCHD eventually replace that income? Let's find out. Right now, SCHD has a dividend yield of 3.48%, so on a $20,000 investment, you'd start by earning about $700 a year, around $60 a month. Not life-changing, I know. But here's the thing: nobody said we'd stop there. The power of DRIP. The real magic happens when you reinvest those dividends instead of spending them. That strategy is called DRIP, Dividend Reinvestment Plan. Every time SCHD pays you a dividend, instead of pocketing that cash, you use it to buy more shares. More shares mean more dividends. More dividends mean even more shares, and on it goes. compounding over time like a snowball rolling downhill. SCHD has grown its dividend at an average rate of 11.04% per year over the last decade, and the fund's share price has appreciated roughly 7.69% annually. Put those together with DRIP, and the growth becomes genuinely remarkable. The numbers, with versus without DRIP. Let me show you the difference side by side. Without reinvesting dividends, year 1, $22,000. Year 10, $42,000. Year 20, $88,000. Year 30, $185,000, with just $16,000 in annual dividends. With DRIP, reinvesting every dividend, year 1, $22,000. Year 10, $61,000. Year 20, $212,000. Year 30, $898,000, generating over $70,000 in annual dividends. That's $6,000 a month in passive income, comfortably clearing that $5,500 target, all from a single $20,000 investment made decades earlier. The difference between those two paths? Just one decision: reinvest or don't. Now, will this happen overnight? No. This is a long game built on patience, consistency, and the power of compounding. But the math doesn't lie. Time and reinvestment are the two most powerful tools any investor has, and SCHD is one of the best vehicles to put them to work. So if you've got $20,000 and you're wondering what to do with it, now you know. And if $20,000 feels out of reach right now, don't worry. Click the video on screen to see how you can build toward this same goal starting with just $90 a week.